Welcome everyone to our webinar on uncovering hidden leverage through pricing and packaging. I'm Nicola, co-chapter lead of London Pavilion, and delighted to kick off the year with our first webinar on this very hot topic, particularly on the impact that AI is going to have on all of our pricing models. Now, before I introduce our rather fabulous panelists, would you all just introduce yourselves in chat? And I have two questions for you today. One, the always controversial question: who owns pricing, if anyone, in your organization? And number two, I would love to hear from you how you would rate your current pricing model. So one is pretty poor and five is, I think we're at pricing perfection. So I will let the panelists introduce themselves, but also just to say, please do ask questions as we go in chat, and we'll make sure we have time to answer as many as possible at the end. So let's start off with some introductions. Andreas, let's start with you.
Hello, Happy New Year. Nice to see everyone. My name is Andreas. I'm an operating director at Notion Capital, which is an early stage venture capital fund in Europe focused on kind of SaaS and cloud businesses. So Andrew on the call is someone we've invested in many years ago and is a CMO of Paddle, one of our investments. And before Notion Capital, I worked in a corporate running kind of a strategy monetization team. And then before that for a specialist consultancy called Simon Kucher and Partners. So I've been working in and around kind of monetization for about 15 years. Yeah, very happy to be here.
Thank you, Andreas. And Lily?
Hello, everyone. Great to meet you all. So I'm Lily Covington. I'm an associate director at a firm called Cruxy. We are a growth intelligence business. What does that mean? That ultimately means we work with high growth B2B tech companies on growth. And a lot of that, as you can imagine, sits in pricing and packaging. And I guess experience-wise and why hopefully there's some relevance here for everyone here today. Very specialist in B2B technology. That's all we do. That's all we've done for 11 years. We as a firm have worked with around 130 different B2B tech companies, mostly at the real scale up, often coming in when they have a private equity investor. I've personally worked with and led around 60 of those engagements. So yeah, really looking forward to diving into what is one of my favorite topics.
Fantastic. And Andrew?
Hey, my name's Andrew, so Paddle is CMO, and we help about 4,500 businesses with their monetization, so self-serve software companies, mostly SMB, who are scaling globally, and we help with their payments infrastructure, which includes some of their pricing, although until recently we had a pricing consultancy as part of our business that we actually divested before Christmas. So end up diving into lots of conversations around how the hell do we set prices, although I think Andreas and Lily have got much more methodology and experience to bring to bear. So I'll be here taking notes.
You are the perfect trio. And interesting feedback from chat so far. Sounds like mostly finance are owning pricing, but without really clear processes on how to manage it as a strategic lever. Thank you, Catherine. And average rating on pricing, 2.5, 3. So definitely lots to be learned. So my first question, how do you even know if you've got a pricing problem? What are the right questions to be asking and some of the areas to be thinking about when you're investigating this? Andreas, can we start off with you?
Sure. I'd probably start by kind of ruling out other potential issues or areas of the business where it could be an issue. Quite frequently, when I was a consultant, we'd be called into a business to do a project, and there was this big hypothesis that it was like a pricing problem. And then you'd spend a bit of time with the business and you'd realize actually you don't really have a pricing problem. You haven't really segmented your market appropriately. You're not targeting the right segments. You don't have the right product. You lack kind of governance and approval and discipline. And so there could be a bunch of things going wrong. So I'd look at it sort of working from the customer backwards and kind of ruling out things. And if you've ruled everything out and in the end you're like, yeah, I don't think it's any of those issues, as potentially pricing is sort of a good way to think it through. So, the things I think about is, do we have a really good understanding over how we segment the market and how customer preferences differ? and their willingness to pay? Do we understand that? Are we focused on the right part of the market? So are we focused on a section of the market where we actually have product market fit? Or are we trying to crowbar product into a section of the market that don't actually see value in our product, and we're using price as kind of a pressure lever, where it's like high discounts, just kind of get it in there, and then they churn. So it's kind of customer segmentation, then it's sort of product and product configuration. So have we configured the product in the right way for a certain part of the market, or was there something off? So that could be, for example, looking at usage data. Are they using your full feature set? Are there only parts of it that they're using? Obviously, staying close to your customers, kind of understanding why they churn. It could also just be a piece around kind of positioning and messaging and kind of clarity of your proposition. So that's how I'd sort of think about it. And then you're left with, okay, it might be a pricing problem. And then if you've ruled out those other things, and it's like, you're seeing very high discounts, maybe that's an indication your kind of rate cards are too high, or if actually you see you're selling above rate card, maybe that's kind of an indication prices are too low. And then the other one, I'm sure kind of Lily will talk about this, is kind of the model. So if you look at your customer base and you look at the prices they pay you, and you have a sense of the value they get out of your product, and again, that might be kind of looking at usage data, and maybe you've got ROI indications, or just through kind of conversation or input through customer success, you feel like your model doesn't really reflect differences in what they're willing to pay and the value they get. Like there's big disparities. That's a big indication as well that you need to make quite a big change. So we had it recently, right? I think on Twitter, Sam Altman kind of wrote about his ChatGPT Pro kind of version. I think it's like $200 a month, something like that. And he was not complaining. It was like, we didn't expect them to use it so much, and they're losing money. I'm sure if they were to look at those pro users, that they'll make money on some, right? But like not every pro user is the same. And so there's a cohort. I'm sure it's power law distributed, right? So within that customer base, there's going to be some that are like absolutely slamming it, or using it for use cases they didn't sort of anticipate. And so their model of per user flat rate doesn't really suit the proposition.
Yeah.
I'll kind of pause there because I'm sure Lily's got more to add.
Should they be thinking more about usage-based pricing? Andreas, I think you need to go in as a consultant. And Andrew, I think that's a beautiful summary of the first point Andreas made. It's not a pricing problem. You just lack general competence. Lily, Andreas has been referencing some of you in quite a lot of this. So what are your thoughts on this?
Yeah, so I think completely agree with the points Andreas made, where a lot of the time the problem is actually value and understanding of value of your product with the customers. The first way that manifests, especially at the slightly earlier stage, is the way that you, number one, segment and even target your market. And then number two, the way that you actually package your offering in a way that feeds into that. And then pricing is often number three. And I what Andrea said resonates, where the amount of times we come in and people are like, oh, people are saying we're too expensive. And actually, when you dig into the data and you speak to customers, it's not too expensive. It's just there's a fundamental disconnect on the value of the product, who you're selling it to, and then ultimately the pricing. So yeah, step one, often we would, echoing the point, but really encourage to look at value. The second point is there are definitely some smoke signals in the data and in the revenue that you can kind of look at and assume that there is, and I'm sure Andrew's got much higher volume of data on this than I do, but we would ultimately be looking for lumpiness and inconsistencies, like customers who look, smell, think the same, but churn is inconsistent, cross-sell and upsell is inconsistent. There aren't these kind of patterns that you would expect. Definitely signals there's something off with pricing and the way that we're packaging. We see that a lot even if you look at your NPS data or you look at your conversion data. If there's just lumpiness and inconsistency there, you can assume there isn't a trend that is really kind of working for us at the moment. And then the third thing that is maybe a bit more specifically pricing related, it's just thinking about what is the value that you deliver to the customer, and is the metric and the way that we're pricing actually, one, disincentivizing that, or two, cannibalizing that. And if you kind of want to think specifically about the pricing, those are a couple of questions to consider. So a really obvious one is, if we drive efficiencies and we're pricing to users, is that right? Another one we see is like on volume-based metrics, where it's like, if someone, I don't know, I'm thinking of a project management tool, and someone might price on the number of projects or the number of workspaces, but you want to incentivize people to be pushing that out, spreading that through the organization. So again, is the way that you're pricing kind of disincentivizing or cannibalizing the value you really want to bring? It's just something to consider if you're questioning the pricing model itself. Is it a problem right now?
Great insights, Lily. And Lily, you know I love a horror story. Have you seen any in some of the work that you've done with your clients?
Too many to count.
Is there one you'd be happy to share?
I can think of one that we are working with at the moment. And I'm sure, just based on the panel that we did with Andreas previously, this is going to be a topic that comes up around simplicity. But we ultimately see a lot of our clients and a lot of people in the market fall between two stools. Number one is something really monolithic and almost too simple, which I think is fine at the very, very early stages of a company. But ultimately, it becomes then very difficult to break down and find levers on which to price. The one size fits all doesn't fit. But what we see more often, especially when we're working with, no offense, very techie, very, very smart people. One of our clients at the moment has literally got every single pricing metric and variable that you would consider in their model, from segment to volume to consumption to users. It's so difficult to consume. So I would say the horror stories are either at one end of that spectrum or the other.
Thank you so much, Lily. And Andrew, as a CMO, when have you in the past realized that there is a pricing problem in businesses you've gone into? What have been some of the key indicators? Oh, we can't hear you.
One of the things that hasn't been mentioned yet when we're looking at lumpiness or inconsistency is tracking pricing also back to margin, because one of the most common problems here is when actually it's showing up in margin inconsistency across customer segments. So maybe your pricing is standard, but actually some customers are super high margin for you and some are super low margin. That's a big indicator that actually there needs to be some discrimination or discrepancy within your pricing to allow for that. And so, I remember the very first time I came across pricing as a lever, not a lever necessarily for overall company growth, but a lever for deal conversion in the opposite to intuitive sense, where we were trying to close a deal. It was we were a content personalization engine, small business selling high deal value into enterprise financial services, and we were getting stuck in procurement. I won't say that the institutional financial advisor we were working with, but we were getting stuck in procurement. We didn't really understand why. And then suddenly we heard through a back channel that it was because we hadn't charged an implementation fee. And they basically weren't going to buy a software license unless they had the cover that they'd spent an extra 20 grand on us implementing it for them. Super simple solve, but that was something that was an add-on that was not in our pricing, that they had an extremely high willingness to pay around. And as soon as we added $20,000 worth of implementation onto our standard license, they signed and it went through procurement, because that was something they needed on their end to see and go through, whereas many of our other customer segments didn't need it. And so that was when my eyes were opened in a very practical sense to, we would have lost this deal and we will have not learned the insight that this was something that segment of the market not just had a high willingness to pay, but needed for the deal to be done.
And an extra 20 grand with work you were going to do anyway.
Yeah, I mean, that's always helpful too, right?
Really interesting takeaway. Thank you. Lily, I just want to come back to you. How much nuance is there between pricing strategies across different businesses? I mean, we all have a framework and a blueprint. Is there one that we can all be using?
Short answer, no. I would say because the value is so nuanced in different products, there's definitely standards which are sometimes set by industry and by use case based on what people are used to, where they've been anchored by competitors, etc. But there's always a nuance in how you're valuable, what you're really delivering, and that should always be taken into account. I would say that kind of at the early stages, there are definitely some principles that could be applied to many different pricing models, pricing frameworks. So even if the actual blueprint is not the same. So a couple of examples of that would be if you're pricing per a metric, making sure that you are giving incremental discounts on that, and as it scales up, another example would be making sure those are in bands or in blocks so that people can kind of scale up and down within that. So there are definitely some kind of principles that you can take into account, but I wouldn't say there's a really fixed blueprint. But there are definitely some kind of ways of, when it comes to executing pricing and the practice and the process internally that sits around pricing, that is probably something that you can have a bit more of a structure and a standardized blueprint around, whether that is, when do you have it sounds a bit grandiose to call it a pricing committee, especially at an early stage, but what is the time and place where people in the business come together to talk about pricing? What do you look at? How often does that happen? So there are definitely some of these processes as well that can be a bit more standardized company to company. But yeah, it's more the things, I don't know, from my experience, at least the things that sit around the edges of pricing as opposed to the models and the frameworks themselves.
Right. And actually, that's so important because it's all very well to come up with a pricing strategy, but it's all about the execution. And we're going to come on to that in a bit. Andreas, when does it actually really start to matter? Is there a particular stage or revenue level that businesses should be thinking, right, now is the time that we have to review our pricing strategy?
I think generally, so it's not the most important thing if you're very early. So kind of, less than 1 or 2 million. It's not, topic one to kind of nail, but you've probably spent some time on it. And then it gets more and more important. I mean, in my experience, about 6 million or so in ARR, it's really worth looking at. And then the bigger you are, the more leverage you have, and the less you've invested, the more upside there is. And then it's always an important topic, right? Because you're always launching new products, you're entering new markets, you're acquiring new customers. So it's always important. Super early, if anyone on the call is super early, it's more kind of the other topics we spoke about are more important. So having an understanding of your market and your customer base and how your product's going to kind of fit into that market and is more important to get right and not overcomplicating it. So you have a bias for simplicity earlier, and then you progressively layer on complexity where it's required. And you use those early days to experiment, because it doesn't matter if you kind of fuck up, right? Because you can fix it. Like if you're $100 million business and you just shift your pricing metric from per user to consumption, that's fraught with risk. It's like a board level decision, right? It's difficult to execute, and it's a multi-year process. If you're like sub 1 million ARR business, you can just do a lot of experimentation, and then it's like, oh, that didn't work. Let's try something else. So I would just use those early days for experimentation and driving learnings into the business. And then progressively, as you grow, it's like more complexity gets layered on progressively. And then you become progressively more disciplined as well. It can't be the kind of Wild West, make up your pricing model type approach.
Which is when you really need an owner. Yeah, I think we can definitely overcomplicate it. I've worked in an early stage business where I think we spent a year debating different pricing strategies, as if we were like a $100 million business, which we were far from. Lily, do you find that there's a certain stage or revenue level where you can really add value in terms of the pricing strategy?
Yeah, definitely. I think it comes with, it's probably less to do with the revenue, but there's definitely a trend there. I would say probably around the 10 mil ARR is when we can see the biggest difference start to be made. But I would also say it's almost, there's some milestones or some things that happen in the business where it is appropriate to take a step back and look at pricing. So some very obvious examples of that being M&A. We see all the time that's an opportunity to take a step back. Bolt-ons, etc., and really think about the packaging and the pricing and making sure there's a clear path to upsell, cross-sell. Entering a new geography or market. Again, not just localizing it. Sometimes it's really thinking about, we have much more diverse value now that we're bringing. Significant changes to the roadmap that are being implemented. How do you make sure that the way you're going to monetize the new things is considered in the context of what you currently have, and you're not just building out this Frankenstein model that just evolves over time. So it's almost, certain milestones in the life cycle of a business. If your customer base has started to change, you've started selling upstream, downstream, etc. Again, that's another time to really take a step back and think, right, is the way that we're packaging and then pricing able to account for the nuance that we're adding to our customer base? So yeah, definitely, in some ways less to do with the scale of the company. I would say we typically work with businesses who are kind of 50 million to IPO stage, and you can do a lot, as you can imagine, at that stage. But any of those kind of critical points in the life cycle of a business as well are just a really good opportunity to take a step back and really think about it.
Right. So one of those key milestones is pricing part of the strategy when you're thinking about those. I think so often when we talk about pricing, we just think about increasing prices rather than thinking of that whole pricing and packaging mix. And Andrew, you just touched on it earlier about implementation fees. What are some of the other alternatives if you're looking to increase margins to just raising your prices?
Yeah, so thinking about add-ons is one piece of advice that we often find useful. We look at the features across the package that you're offering and thinking which are those that are really valuable, people have a high willingness to pay, but actually only a small proportion of your customers have that high willingness to pay. That was the example I shared earlier about that financial services company. There was a small segment that had very strong willingness to pay for that feature. People, when there's maybe 15, 20, 25% of your base willing to pay a lot more for something, that's a perfect example of something that should be removed out of your main package and put as an add-on. So think about add-ons is one key thing. I think it's also interesting seeing the rise of multiple value metrics. Lily mentioned value metrics at the top. So this is the currency of exchange for your software, your service, your product. So number of seats or amount of tickets sold or whatever the value metric is. And we're seeing people become more nuanced in layering up multiple value metrics. So if you look at some of the recent plans coming out of Grammarly and some of the other tools, it's moving from not just seats as a value metric, but seats plus amount of usage or seats plus amount of completions, which gives you two dials to turn. And as you start to do that, one of the things that we've seen very perhaps subtly, it's not been talked about much, but in 2024, a lot of people improved their monetization via shrinkflation rather than via price rises. Because of the inflationary environment, there was lots of pressure on people who are trying to raise their prices and that turning away customers. And so effectively, they reduced the thresholds for their plans rather than increasing the headline price. Same thing as us going into Sainsbury's and finding our bag of cornflakes, our box of cornflakes is now half the size as it used to be at the same price. So that's a way you can actually drive better monetization for your product set without a headline price increase. So there's definitely lots of things you can do there that don't need to change your plan from $50 a seat to $75.
Oh, Andrew, you made me think about Toblerone and how they reduced the chocolate in there. Shocking behavior. I think it's really interesting what you said about add-ons though as well, because so often you give away things for free, which actually have no value to some of your customers and are hugely valuable to others. So actually just take it out of that package and start charging separately for that. Lily, coming back to something that we touched on earlier about the execution piece. Let's say we're going to change our prices. It could be raising them, having add-ons, rethinking about the usage model. Once you've decided that, what's the best way to actually implement this? Because I think there's so much panic in a business. I know that whenever we've done pricing changes, you always get a huge concern about churn and reaction from your existing customers and how's it going to impact sales. So you talked about there being a sort of blueprint for this area. What's your recommendations here?
So firstly, it of course depends on your customer base. Is it a high volume, lower value customer base versus enterprise sales, for example? So definitely nuance on the approach there. I think some principles, well, number one, you're never going to get a price change exactly right. There is no, pricing is a science and an art for the most case. I think consumer slightly more scientific in many ways, but in the most part, it is something that's never going to be absolutely perfect. So oftentimes you have to get to what you believe in with good evidence and go. So what is almost more important is the way that you track and monitor the rollout of that. So to make that easier, we would always recommend piloting with a small group of customers, with a small cohort, do that, test, learn, get the feedback, then go to the next group. So really breaking down, I guess, that waterfall of change and really making sure you're tracking the leading, but also the lagging indicators. So by lagging indicators, obviously the uplift, the conversion, what's working, but then the leading indicators being actually the feedback that you're getting in market from some of those conversations. Again, just making sure you have that pulse internally with the sales team or, a cross department team to see, right, what's working, what are we hearing, what's not, do we need to just crack on or do we need to take a bit of a step back? So a lot of it's really in the way that you track and monitor the rollout of it itself. And then something else which, some may seem obvious, but honestly, the amount of clients we have where this isn't the case. And I think Paddle have actually quite a few really strong examples. I know I've seen on the screen at SaaStock some of these on the screen, but value-based messaging with the rollout. So, not just we're raising our prices because of inflation and it's going from here to here. Let us know if you've got any problems, but really making sure that you take the time. And every time we say this to our clients, where it's like, you need to be making sure there is something that is bespoke in that message. People hate us, but honestly, the conversion literally triples if even the first line is, over the last 3 years, we've delivered this kind of ROI, you've used us in this way, and we want to continue, delivering that value. People want to obviously, shove it through a sales loft cadence, but honestly, if people just take the time to make sure that the messaging is really value-based and it's done on a call, in a meeting, whatever it might be, depending on, the degree of shift, but that makes such a difference.
Oh, Lily, it's so true. The number of times that you're using a platform, you don't hear from them in months, and then you just suddenly get a message going, by the way, our prices are increasing. You're like, whoa, this feels quite abrupt. And then, do I even still want to work with you? Maybe not. Andrew, Lily's just passed over to you. So we'd love to hear some examples of how you use value-based messaging to make sure you get the best conversion rate and reduce the potential churn from any change.
Yeah, I mean, the basic principles of that message, and unfortunately last year we saw a lot of bad messaging around price increases, like people just not thinking about this well enough. Lily mentioned the key thing there, which is making it personal and making it value based. So you're communicating from a founder or for a senior person in the business. So it's someone taking responsibility, someone explaining why it's necessary, showing the value that's been delivered by continued changelog improvements, continued improvements in the product or service, and what's needed for sustainability for the business so you can keep on providing that service. There's another piece that we find really key, which is then allowing an out. Making sure that there's some form of asterisk or postscript, some note saying, if this is a problem, let us know. And what you find is if you allow people to get an out, if you allow them to raise their hand, if this is going to cause them difficulty, you enable a conversation, which means you can be much more nuanced with those subset of people where it's going to cause an issue. And we find that very few people take you up on that, but those that do often have a business critical issue that you can then lean in and give them a paused plan or give them some form of other extended discount. So yeah, if you make sure it's personal, you make sure it's value based, and make sure there's some pressure release valve within that messaging, and that normally is the better way of communicating.
And any tips on what absolutely not to do?
Well, I think we've probably all received a few messages over the course of the last 18 months with a CS rep or someone who it's not their decision, just basically telling us that we're going to see a 30, 40, 50% hike. I think in a different forum, Nicola, I shared one that happened to us, which I won't name in case anyone's from them on this call. But yeah, it can really engender a massive collapse of trust when it comes 2 weeks before renewal with a massive increase and with no justification as to why it's needed. So yeah, I'm sure we've got a few of those emails in our inbox pre last renewal.
Yeah, I think that justification is so important. Andreas, we talked earlier about, particularly looking at your pricing when you're expanding into new geographies. What are some of the challenges that you might be up against when implementing regional or global pricing, and how do you best handle those?
Yeah, I guess it depends on the nature of your proposition and how transparent your pricing is. If it's kind of opaque to the market, you can get away with a lot, right? But if you're more kind of a PLG type business, you're obviously more constrained. You can do it more easily, I guess, if it's transparent with sort of the currency, and you kind of push US dollar a bit higher. But yeah, if it's really opaque, there's generally not an issue because people just don't know what's happening. Where you run into issues even when it is opaque is for global businesses with like central procurement. That can obviously be problematic, and then you need to kind of have more sort of standardized pricing for those customers, or you just need to be careful if you're selling into one department or one region and then you expand into the other, chances of them talking and comparing notes is pretty high. So you've just got to be cognizant that may emerge as an issue, which you have to sort of resolve at some point. But I'm guessing the kind of scale of businesses on the call, that's probably less of an issue. Could be wrong.
So if you're thinking about expanding into a new geography, Lily, what's the best way to then think about how to best price there rather than just doing a direct conversion?
So I would always think about what's different in that market. Again, going back to value, sorry, really boring and repetitive, but it's like, where is the market anchored differently to what you're used to? So we see it all the time. For example, we do a lot in like the office of the CFO tech stack. And you see such differences, just, UK versus US, for example, on what's the ERP they're using, how many different systems are they used to using, what is the budget that you're kind of going into the context of is often quite different. And therefore, the way that you anchor value is quite different. Again, price point, a really obvious one, we use a converter that we have a lot of times just based on very generic price sensitivities that are different across markets. So always, taking that into account. But yeah, it's really thinking about where is the market anchored and how is that different? How have the competitors set a different expectation? Is it more competitive and therefore do you need to compete much harder on things like product and value and price? Or is it much more greenfield? So again, it's coming back to just thinking about what is the context switch, less about, okay, I'm going to the US, I can up my prices 20%, more about, hang on a minute, where do I actually now sit in the context of this market? And what does that mean I need to do differently in packaging and pricing? And even on the packaging, we definitely see, if I think of banking technology, for example, we see huge differences in the US versus Europe, where Europe have, banks have much more an appetite to take really modularized kind of things. Dare I say it's an arrogance of the banks in the UK, but they kind of want you to plug into their big architecture that they've spent millions designing with a big consultant. Whereas in the US, there's much more of an appetite to buy more platforms. So even just thinking about those nuances in the packaging can also help you to protect and unlock the value as you move across markets.
Right. So don't just focus on pricing. Andrew, how have you managed this at Paddle? Do you have global pricing or is it regionalized?
We have the simplest pricing model out there. It's 5%, 50 cents for every single person from the first dollar they spend with us or the $100th million they spend with us. And so we try and keep it super simple, and yeah, we don't discriminate. But that's because it's a entirely consumption or usage-based model. However, we have very good data on what happens if you're able to geographically discriminate in your pricing. So a lot of our proposition is helping software companies scale globally with their self-serve offering. And so price is usually very transparent, but also price is able to be easily manipulated market by market. And so, I think our latest data shows a 31% increase in conversion and revenue if you show local dollar on your pricing page, local currency on your pricing page, and if you also adjust for willingness to pay in each region. And that can be difficult quant studies, or it could just be as simple as looking at the Big Mac index of how much people pay for a Big Mac in each region. So we see very, very strong data in terms of conversion rate and growth when you do take account of international differences.
Is that insight that people can access on your website, or is it internal?
Yeah, I can follow up with a bunch of reports on that if it's interesting to anyone. Obviously, this stuff is the market we serve is largely self-serve and is at cheaper price points. So this is not $100,000 a month type deal. Most of our customers are selling at £10, £100, £1,000 a month, and it's at that price point we've got all the data. So yeah, if anyone's interested at that price point, we can easily supply.
I think there'll be lots of interest. And just staying with you for a second, based on all the companies you work with and a lot of the reports and insight you have, what are the most important pricing related metrics that SaaS companies should be monitoring on a regular basis?
The boring answer is it depends. I think the things that you should be thinking about when it comes to assessing whether pricing works or pricing changes works. I think you should be thinking about conversion rate. You should be thinking about margin impact. But the things that people normally go for are average order size and seeing whether they're able to drive up average order size as a result of a pricing increase. Other things that can be perhaps a couple of clicks away are speed of deal close. I think that's sometimes really interesting, and simplicity sometimes really reduces the speed of deal close. So it's not just about reducing prices to improve deal speed. It's about actually making it more simple and easy to understand.
Right. And particularly, I think margin per segment, because sometimes you can find some segments are hugely profitable and others you're losing a ton of money and just no one's ever really broken it down. So really important to break that down as well. Andreas, anything you wanted to add in terms of metrics? Anything that you're seeing is important, for VCs when they're evaluating businesses as well?
No, I think there's well, like what you'd kind of report to the board and investors and whatnot is different to what you might track to manage pricing or monetization specifically, right? So I don't think I need to comment on sort of what you're reporting on to kind of investors. But I guess usually businesses are pretty weak in terms of those operational metrics. So for example, they usually, they're tracking like net prices and what customers are actually paying and spend. They're usually not tracking discounts accurately. So typically rate cards are not in the CRM or CPQ. They're like in some Excel document somewhere or a PowerPoint. And so there's like a disconnect. So yeah, usually there's an issue with data. And so they're not really looking, there are metrics missing, and usually it's around kind of around sort of list prices and discounts. And then maybe not having appropriate splits, like looking at different segments and looking at different regions, and then looking at how discounts vary, for example, across those different regions.
And different salespeople. No, that's really relevant. How much you're actually losing out with those discounts. Lily, my favorite question of today, I think. With the rise of AI and automation, do you foresee shifts in how SaaS companies will price their products in the future? We've talked about this a little bit, and consumption-based pricing was one of the biggest trends in all the 2025 forecasts. So what are your views on this?
Yes, the wild west of AI pricing. I think there's a few trends that we've seen. Yes, the rise of consumption-based pricing. I think everyone's trying to shift more to an outcome-based pricing model, but it's really difficult at the moment to know what actually is a valuable outcome because, these technologies are still very nascent in what they're delivering. We've all, I think Andreas referenced the GPT example. I think some others around, I think Salesforce have changed their Einstein model now to agent force because, you know, attaching the value of AI to their existing per user model wasn't working. So I think the answer is no one really knows. And I think it would be kind of farcical to suggest that, you know, certainly I or anyone has a great knowledge on exactly how this is going to work and play out. We definitely are seeing some trends in how people are approaching it. I think it really depends on what the role of AI is within your current, you know, product stack. In many ways, is AI the central technology and driving the central value of the offering, or is it now an add-on that's just enhancing, you know, let's say the efficiency, the speed, the accuracy of what you're already selling, in which case maybe it makes sense to adopt more of a hybrid model that has a closer tie to the way you currently price versus a completely separate thing. Is it actually diversifying your value so much where you're kind of able to bring out something on top or in addition? We've seen lots of companies either, you know, baking it into their existing tiers, which, you know, there's a lot to be said for that, especially when it kind of sits quite seamlessly in the current product. And, you know, we see for a lot of use cases that could be quite an interesting model, because it means that not only are you going to get the data to learn and see where people are getting value, how are they using it, and you can kind of scale that way. There's definitely risks associated to that around, you know, especially when you think of the profit and the margin, and that might inflate beyond what you can control. So yeah, I don't have a straight answer on this, unfortunately, but you know, I think the main thing is just really thinking about what is the role and the value of the AI technology in the context of what problem you're solving. Whereas I think everyone's jumping to consumption-based because it's become quite quickly the status quo for AI-based pricing. But we're certainly seeing with some of these much, you know, as I said, most of my experience is more in the enterprise deal space, but we're certainly seeing a lot of pushback from procurement and buyers where they're like, I don't know what a credit means. Like, I don't know, what am I going to have? What am I signing off for the next year? And it just becomes really difficult for the buyer. So yeah, those are just a few things that I've seen, but unfortunately no kind of real, you know, exact answer on what's a great model.
I don't think we know yet, do we? And also, you know, from the seller viewpoint, how on earth do you forecast in consumption-based pricing as well? It's tricky on that side too. Andreas, what are your thoughts on it?
So I mean, the pure consumption-based businesses we see are infrastructure, right? And so they price on that basis for good reason, because they're variable cost. They've got meaningful variable cost, which they need to account for. And so it's those cost dynamics that push kind of in a consumption model. But as you move kind of along the value chain, it becomes less and less consumption-y. Well, the necessity to have the cost dynamics change, right? Where you might not have as material variable cost dynamics, and so you can have things that are much more kind of fixed rate. And I think the general trend is to something a bit hybrid-y, so fixed plus or kind of tiers, or fixed plus some kind of overage, because I think both suppliers and buyers are schizophrenic on this topic. So on the one hand, if I'm a supplier and I have a fixed rate, more kind of fixed model, then I start asking questions around, am I not leaving money on the table? There's some customers that are really using the product a lot. I can charge more if it was more consumption based. Or you might think, actually, you know, we've got quite a high entry point and there's sort of customers that just want to try us out. You know, if we were kind of consumption based, they could just kind of try it, and so then you think, okay, maybe consumption based would be better, or something a bit more kind of dynamic. And then the CFO is like, but that's going to be a nightmare for forecasting. Don't like that. Your investors don't like it. And so you've got these sort of competing tensions. And it's the same on the buyer side, right? They're like, I'd love to buy kind of consumption based because I want to try you out. And then they grow into you. And then they get to a point where it's like, shit, we're spending a lot of money with you. Like, we need to have a conversation about this. I can't forecast. Like, let's agree a fixed rate. And so you just kind of have these swings both in the supplier and buyer side. And I think that's why we're kind of landing on sort of more hybrid models. Or even if you look at Snowflake, right, we think of them as consumption based and the mechanics are consumption based. Same thing for AWS. But what do they do for their larger customers? It's fixed commitments. AWS, it's spend $3 million with me within 3 years. And if you don't, I'm going to send you a bill. Same for Microsoft. And so, I think it can be misleading. We think of some of these businesses as being consumption based, and to an extent they are, but they also have significant kind of fixed elements to them, especially for kind of those larger customers.
Yeah, it's like a minimum guarantee or like a fixed cap of it won't be over this. Andrew, I see you're nodding. What are you seeing from some of your customers in that move?
Well, I just think there's a couple of things that are happening here, and I feel like I'm constantly mentioning margin. Lots of companies have added AI features onto non-AI birthed businesses. And this is having a destructive effect on their margins if they're not thinking about monetization for those feature sets differently. Because this stuff costs, variable costs are high, as Andreas said. And so we're seeing a really interesting kind of rise of people getting scared of the things they announced last year that were really cool and compelling in the market, now eroding their traditional 80% margins. And the more that people use the things that they added on last year, the worse their margins become. We did some research with Kyle Poyer and the team at OpenView last year, which was really interesting. It was about maybe 18 months ago, which was those that added AI and did not monetize it explicitly, that was actually an inverse correlation with outlying growth. And those that monetized it explicitly, it was correlated with those who are in the top quartile of growth. So an example would be Intercom, they've got an AI resolution fee. So if AI resolves the chats, they charge a fee. And so it's a very clear pricing for the AI capability. We saw that early signal 18 months ago, and now we're seeing it play out in people's margin structure. If they didn't think about their monetization of the AI capability separately because of the margin impact, not just because of what the buyer wanted, we're seeing people see some unexpected consequences in their businesses. So yeah, I think it's super interesting, and the stuff from Sam Altman over the last week has been funny to see all the reactions to that. I think one of the reactions was perhaps this was entirely intentional, and he's playing chess, not checkers, because now everyone else has followed his pricing model, and no one else has the capital reserves of OpenAI to keep up, which I'm sure isn't the case. But we have to really, really consider the margin impact of this model.
Definitely one to watch. And why do you think businesses are giving it away for free? Is it because they don't understand the value, or because they're scared of charging for it?
I think it's both. I think people are learning. We're all learning on the go. It's so interesting working with loads of founders who are, AI native founders building businesses on top of these models. They are the most hustle-full, hurried, scared, anxiety-filled cohort of founders I've ever come across, because literally the foundations change on a weekly basis for their entire business. Even if they're very deep in this, everything changes. And so, no wonder that if that cohort of founders is finding this hard, those who are just using LLMs via APIs are finding it hard to work out how to do this. But you've got to be in the game, otherwise you're behind. And so I think it's just you've got to be there, you've got to be testing, but you've got to stop and think about, is this what the buyer wants? Is variability how they buy? I think the point that was made earlier about people want variability at the early stage and they don't want it as they scale. There's real truth to that, and we've just got to think about this as we increase basket size of our customers as well.
And Andrew, while I've got your questions just coming from Ben, do you have anything you can share about the margin erosion impact when not monetizing AI add-ons? Anything you've seen from your research?
Ben, I was chatting with someone a couple of days ago, and I'll try and find something that they shared online about this. In fact, I'll try and share it before we leave the call. Let me just drop it into the chat if you give me 2 minutes. Basically, if you're not monetizing these things explicitly and they become a dominant part of the usage of your product, then in effect, you are just suffering sometimes a 10, 15, 20% margin reduction of your overall cost to serve. Let me just find that out.
Great, thank you. So I have 2 more questions, and then we'll come back to some of the questions that have been raised in chat. So we'll start with you, Andreas. Who should own pricing in the organization? I've often seen that there is no one owning it, or it can vary from product to sales to finance to marketing. So who do you think should own it? And what would be your one takeaway for everyone that's joined us today?
So early on, I guess it matters less. So your kind of Series A business, maybe getting to kind of Series B, it doesn't matter so much. It's just as long as someone or a few people are looking at this topic, and it should be, I think, a topic that the founder is thinking about, and is spending some time on, and then as the business grows, the requirement to find some kind of home for it grows, because otherwise it just becomes this kind of forgotten child. That's quite important. So you need to find a home for it. The difficulty is that it's really cross-functional, right? And it needs input from product, marketing, sales, CS, finance. And so there's multiple places that it could live. I think to an extent, let's say you're like a mid-sized business, it depends to some extent on the personalities. So let's say you had someone in product marketing that was just passionate about the stuff and was interested, that could be a good home. Or maybe there's someone in product that is really interested in the topic and could kind of own a portion of it. So I think when you're kind of mid-sized, like the personalities matter. It's got to be someone that's like interested, has the skill set, is going to spend a bit of time on it. But ultimately, like if you made a list of all the different activities or topics that go into monetization, ultimately you can't find a home for all of those activities in one place. So some of it is going to be the responsibility of marketing, some of it's going to be more products, some of it's going to be a bit of finance, some of it's going to be a bit of sales, and that's the reality of it. So I guess it's more about being clear about managing monetization, what goes into that. So what are the lists of tasks? And then it's like, who owns that? Who's like consulted? And then having a forum where you can discuss these things. So that might be like a monthly monetization committee that is chaired by someone. And then each month you kind of discuss a topic and you tick it off and you kind of work through it. And so that's the way I'd kind of look at it for sort of mid-sized businesses. When I say mid-sized, maybe, I don't know, up to 40 million or so. And then beyond that, if you're kind of 50 million plus, you can start thinking about like a dedicated head. So you bring in kind of a pricing professional that knows the topic really well and can start to kind of coordinate these different functions. But it's a tough question to answer because there isn't really one right answer, and it really depends on the business and the personalities within the business.
And what would be your one takeaway for everyone that's joined us today?
One takeaway is a word that Lily used, which is context. Everything is context dependent, right? So like people like to talk about like playbooks, and you see a lot of this like nonsense on LinkedIn, my 10 steps in terms of how I like accelerated outbound and blah, blah, blah. It's like your business is unique, your customer base is unique, your cost dynamics are unique. You should be working from first principles based on the context of all of those different topics to develop your monetization strategy, right? You can't kind of just copy it from someone else and expect to be successful.
Thank you. Lily, what's your one piece of advice for everyone that's joined us today?
I won't repeat Andreas, even though I think that's a great one. Maybe something we haven't really discussed, which is the role of services in your pricing. And I would just encourage everyone to think about, it's a bit of a dirty word in software pricing and SaaS monetization, but actually service is an extension of your product. Service is often the conduit between your customers actually getting value from the product. Service is also an enabler to upsell, cross-sell, and also really understanding the value. So maybe just have a think about the role that services is playing in your monetization strategy as well.
Great one. And Andrew?
The data point that I found super interesting when we acquired Price Intelligently was that they did this study over multiple years where if you tweaked, experimented with your pricing or your packaging every 3 months, then your average revenue per user, your average revenue per account outperformed those who didn't by 103% over the course of 3 or 4 years. So basically just making this a focus and thinking about it. Yes, if you're at scale, yes, if there's a reason to, but just building the muscle in your business where every quarter you stop and you think about what thing we could test or what thing we could experiment, what segment could we try something new in. If you do that, some of it won't work, but you're learning and you're building flexibility and that test and learn mode into your business. So yeah, biggest bit of advice is you've just got to book time in the diary and try this. Find a few people who are going to be decision makers, get an hour once every quarter, and just try something so that you're on that learning journey.
Wow, not just 100%, 103%. It really can't be an afterthought. Thank you for some fantastic tips there. I think we've got time for 2 questions. So I'm going to go with a question from Andy, which was, is being overly transparent with your pricing an advantage or disadvantage? For example, just communicating the price versus breaking down what is fully included in the price. Lily, Andreas, any thoughts on that?
So I think the one thing, sorry, it's really annoying, but it's always going back to the context, but it's like your customers don't really care about your costs. That's something we care about. So it's really thinking about the role of that add-on in the product. We've worked with businesses where actually to deliver the value in the product, they're really reliant on an add-on or a third party to do so as a fundamental part of the workflow, in which case you might have to make a different decision about the margin and the way that you monetize that versus it being something that is separate and is maybe, high value for say 30% of your market. So it's also thinking about what is the role of it and what's the value add within the context of your product, because that might help you just shape the decisions you make. What margin will you accept? How much do you want to monetize this? How many people do you want to take it? Just it's a slightly different approach and I guess goal.
Andreas, anything you want to add?
I wasn't sure on the question exactly. There's a couple of ways to look at it, because it could be, should we have pricing on our website is like one way to look at it in terms of transparency. That depends on kind of the nature of the product. If it's lower value, higher volume, probably yes, it's helpful. If you're selling kind of enterprise deals, high value, and every customer looks a bit different, terrible idea. Don't do that. So again, kind of context matters. And then if you're more talking about kind of transparency on an invoice or kind of an order form, it can cut both ways. So procurement love you to cut things up into lots of little lines so they can compare you and like hammer you on specific line items, right? So what do? You bundle things up and you say it costs 100K and you get this stuff, so you obscure it. So that can work in your favor as a supplier. But then on the other hand, you probably don't just want one price. You want multiple price elements, because if you just have one price on kind of an offer, they just hammer you on that price point. Versus if you had like a few price elements, and then you can say, well, I can't negotiate the service element because that's costing me people, like I can't touch it, but maybe we can talk about this other thing. We can talk about a setup fee or something. So it's a bit of a balance. I think you just need to think through for your customer base, try to put yourself in their shoes and how they'll kind of think about it.
Great. Thank you. Well, we're pretty much at time. So I'm sorry we didn't get to answer all the questions, but I do know that Andreas, Lily, and Andrew are very happy for you to reach out to them on LinkedIn, and I'll include their profiles in the follow-up message if you do have further questions. So I will follow up with a recording, because some of you may want to revisit some of these elements because there's so much fabulous insight in here. And also you may want to share it internally, maybe something you want to share with your CFO. And I will also try and include some of the links that Andrew shared in the chat and some of the points that Lily's put in there as well. So massive thank you to our three wonderful panelists. So insightful as always. I wish I had you in my pocket when these pricing questions come up. Really appreciate your time. And thank you for joining me for the first Pavilion webinar of the year. I feel very honoured to have such great guests. I don't know how we're going to follow this up.